Chairman, thank you, Madam Chair, for your leadership. Some of my colleagues in the Congress have called on the Federal Reserve to use a formula, a very strict formula in setting interest rates. Many times they refer to the Taylor rule. Could you explain to us how this would affect particularly working Americans? Would it be good or bad, and how do we explain its ramifications to our constituents?
Well, right now, the Taylor rule would call for a short-term interest rate somewhere between 3.5% and 4%, which is obviously a much higher value of the federal funds rate than the FOMC has deemed appropriate given the needs of the economy. I believe we would have a much weaker economy if in the last number of years we had followed the dictates of that rule. Unemployment would be substantially higher, the labor market would be weaker, and instead of inflation, which is running below 2%, and we want to see it move up to our 2% objective, I believe inflation would likely be lower than it is now.
So we'd see fewer jobs, higher mortgage interest rates, a weaker economy if we were essentially just automatically following a formula.
That's right. I recently, a few weeks ago, gave a speech at Stanford where I tried to explain why I thought it was appropriate to adjust the recommendations of rules like that to take into account, for example, the fact that not only the FOMC, but most outside forecasters believe that the so-called neutral rate of interest has been unusually low in the aftermath of the crisis. And the Taylor rule would assume that it's at 2%. Current estimates would put that estimate closer to 0.
Thank you. There's another aspect I've been working on for years, and particularly incorporating some of the language in the Dodd-Frank bill, is ensuring that clearing platforms are used, but there is a risk because systemic failure would be significant. So can you give us an update on what you are doing, your colleagues, to ensure that these central clearing platforms are adequately protected from a failure, i.e. the consumer is ultimately protected from failure?
Well, we strongly believe that well-regulated and well-managed financial market infrastructures, and that would include central counterparties, play a positive financial stability role. They can help stem the propagation of disturbances, and they reduce the volume of transactions among key financial institutions. And we think they play a financial stability role, but they can also be sources of risk to the financial system if they're not themselves well managed. Title VIII of Dodd-Frank created a structure in which the Federal Reserve, the CFTC, and the SEC have oversight responsibilities to make sure that these key infrastructures of our financial system are managing their own risks successfully. And we're cooperating with the other regulators in our examinations to make sure that appropriate risk management standards are in place.
Thank you. Final question in that. Cyber security is the issue on everyone's mind, and you recently have an advance notice proposed rulemaking which would require board of directors to have adequate expertise. I've been involved in legislation that would apply not just to financial institutions, but a publicly held company, because the cyber threat is not limited, it is ubiquitous. Could you just briefly, and very briefly, give us your sense of how important it is to get this cybersecurity expertise on boards?
Well, I think cybersecurity is a major, major risk that financial firms face. I think they're very well aware of the risks, and my sense is that boards of directors generally appreciate the seriousness of cyber threats. but sometimes they don't have a comprehensive or enterprise-wide view of the institution's capabilities in this area. And so it is very important for boards to have appropriate expertise.
Thank you very much, Madam Chair. Thank you.
Some have remarked that banks are not lending now. Is that true?
Well, a recent survey by the National Federation of Independent Business, which is smaller businesses, indicated that only 4% of respondents were unable to get all of the loans that they needed, and the fraction of businesses ranking inadequate access to credit as their main problem stood at 2%, which is an extremely low number.
So just because people in
lending has expanded overall by the banking system and also to small businesses, C&I lending.
Just because people in high places say it's true doesn't make it so. Are U.S. banks competing? Others have said that U.S. banks can't compete. Are U.S. banks competing relative to their international counterparts?
U.S. banks are generally considered quite strong relative to their counterparts. They built up capital quickly, partly as a result of our insistence that they do so following the financial crisis. And as I mentioned earlier, are very well capitalized, and their lending, their price to book ratios are substantially higher than the ratios of banks headquartered in other areas, and they're gaining market share, and they remain quite profitable. In my remarks today, I will briefly discuss the current economic situation and outlook before turning to monetary policy. Since my appearance before this committee last June, the economy has continued to make progress toward our dual mandate objectives of maximum employment and price stability. In the labor market, job gains averaged 190,000 per month over the second half of 2016, and the number of jobs rose an additional 227,000 in January. Those gains bring the total increase in employment since its trough in early 2010 to nearly 16 million. In addition, the unemployment rate, which stood at 4.8% in January, is more than 5 percentage points lower than where it stood at its peak in 2010, and is now in line with the median of the Federal Open Market Committee participants' estimates of its longer-run normal level. A broader measure of labor underutilization, which includes those marginally attached to the labor force and people who are working part-time but would like full-time jobs, has also continued to improve over the past year. In addition, the pace of wage growth has picked up relative to its pace of a few years ago, a further indication that the job market is tightening. Importantly, improvements in the labor market in recent years have been widespread, with large declines in the unemployment rates for all major demographic groups, including African Americans and Hispanics. Even so, it's discouraging that jobless rates for those minorities remain significantly higher than the rate for the nation overall. Ongoing gains in the labor market have been accompanied by a further moderate expansion in economic activity. U.S. real gross domestic product is estimated to have risen 1.9% last year, the same as in 2015. Consumer spending has continued to rise at a healthy pace, supported by steady income gains, increases in the value of households' financial assets and homes, favorable levels of consumer sentiment, and low interest rates. Last year's sales of automobiles and light trucks were the highest annual total on record. In contrast, business investment was relatively soft for much of last year, though it posted some larger gains toward the end of the year, in part reflecting an apparent end to the sharp decline in spending on drilling and mining structures. Moreover, business sentiment has noticeably improved in the past few months. In addition, weak foreign growth and the appreciation of the dollar over the past 2 years have restrained manufacturing output. Meanwhile, housing construction has continued to trend up at only a modest pace in recent quarters. And while the lean stock of homes for sale and ongoing labor market gains should provide some support to housing construction going forward, the recent increases in mortgage rates may impart some restraint. Inflation moved up over the past year, mainly because of the diminishing effects of the earlier declines in energy prices and import prices. Total consumer prices, as measured by the Personal Consumption Expenditure, or PCE price index, rose 1.6% in the 12 months ending in December, still below the FOMC's 2% objective, but up 1 percentage point from its pace in 2015. Core PCE inflation, which excludes the volatile energy and food prices, moved up to about 1.75%. My colleagues on the FOMC and I expect the economy to continue to expand at a moderate pace, with the job market strengthening somewhat further and inflation gradually rising to 2%. This judgment reflects our view that U.S. monetary policy remains accommodative and that the pace of global economic activity should pick up over time, supported by accommodative monetary policies abroad. Of course, our inflation outlook also depends importantly on our assessment that longer-run inflation expectations will remain reasonably well anchored. It is reassuring that while market-based measures of inflation compensation remain low, they have risen from the very low levels they reached during the latter part of 2015 and first half of 2016. Meanwhile, most survey measures of longer-term inflation expectations have changed little on balance in recent months. As always, considerable uncertainty attends the economic outlook. Among the sources of uncertainty are possible changes in U.S. fiscal and other policies, the future path of productivity growth, and developments abroad.